Hi everyone, welcome back to Demand Decoded. Dan here as usual, and we've got Josh back again, who was introduced on the last episode. If you missed that, well, you have to go back and listen to it, but Josh is our new CEO of Americas at Blend, and yeah, go back and listen to the last episode where we introduce him fully and get just a smidge of his expertise, which now we're bringing more into this episode too. And we're covering private equity and what private equity firms really care about when it comes to marketing. And you probably won't be surprised to hear, it's not traffic, it's not lead volume, it's about marketing that actually drives EBITDA, growth, retention, and ultimately the exit value for the business. And yeah, there's kind of nobody better, I don't think, to break it down than Josh here, who not only brings marketing and sales expertise, but also first-hand experience in the PE world, which is really valuable to this conversation. And we're going to dig into the expectations from PE owners, post-acquisition, the KPIs that really matter, how to align the marketing strategy to those financial goals, and the mistakes to avoid if you want to actually build a marketing engine that drives true enterprise value. So yeah, really excited to get into this conversation, Josh.
Thanks for having me back, Dan. This is a fun topic, so yeah, looking forward to the conversation.
Yeah, we were kind of just chatting before as well. It's a timely episode because we've got a lot of customers, and we will likely have a lot of potential customers too that will work with us in the future that are PE backed. And understanding what they're truly looking for from marketing is really important.
Yeah, I agree. It's like we talked about in our last episode. Oftentimes, marketing isn't invited into the boardroom, or at least the mid-level marketing teams that would really benefit from understanding the context of the investment that the private equity group made. Oftentimes are left out of that conversation. So hopefully today we can give them just a baseline of what those investors are thinking about, how they measure value, and then give them a way to be able to articulate the results that they're driving in a way that investors will consume and appreciate.
Yeah. And I feel like I mentioned this a couple of times on the last episode, but this isn't a tactical episode about how to rank first in AI search engines. But if marketers can truly understand this level of thinking around what matters to ultimately the people investing in their business, that's really going to help level up the thinking, the execution, and the strategy behind all of that.
That's exactly right. It's a more purposeful, when you know what the outcome is that you're trying to drive, you can be more purposeful in the decisions that you make, right?
Before we get into the episode today, here's a quick word from our sponsors, HubSpot. You don't become the world's most valuable women's sports franchise by accident. Angel Cities Football Club did it with a little help from HubSpot. When they started, data was housed across multiple systems. HubSpot unified their website, email marketing, and fan experience all in one platform. This allowed their small team of just 3 to build an entire website in just 3 days. The result? Nearly 350 new signups a week and 300% database growth in just 2 years. Visit HubSpot.com to hear how HubSpot can help you grow better. All right, cool. Well, let's kick this off because I think you kind of wanted to run through, and give me as well an indication of what happens behind the PE lens during deals and afterwards and all of that.
Well,
all of the in between.
Yeah, I think the important things to understand as a marketer who's working for a PE firm is how did that PE come how did that investor group come to the investment that they made, and what is the math behind that? So generally, when private equity, growth equity companies look at an opportunity, they're going to look at a wide variety of metrics, and then they're going to apply multiples to them and to come up with an investment thesis that they can look to execute on. That creates the valuation. They're looking at EBITDA. They're as a percentage of revenue. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's supposed to most closely evaluate operating costs without getting a lot of other, non-operating costs impacting the net earnings. But they're looking at revenue growth, primarily recurring revenue growth. They're going to look at retention rates, both gross and net. We talked a little bit about that the last time. So there's a variety of metrics, but let me just walk you through the math of maybe a fictitious example, right? So let's say you had a $60 million revenue company, and that $60 million revenue company, it's recurrent. Let's say it's 100% recurring revenue, which never happens, but it'd be great if it was. And then they're doing, let's call it 15% EBITDA. So that's a 25% EBITDA rate, right? Let's assume that they're growing at 15 to 20%. So that makes them what's called a rule of 40. Their growth rate, which 15 to 20% plus their EBITDA percentage, which is 25%, is 40 to 45. That's called a rule of 40 company, and that type of math right there determines what level of valuation or valuation multiple that company may put it on. Now, where venture investors tend to invest in multiples on revenue, PE tends to invest in multiples of EBITDA. And so something like that $15 million EBITDA company might sell for, let's call it $180 million. That's 12x the EBITDA rate. At that price point, that investor can fund that in two different ways. They can just write a check with the cash they have in their fund, or they can use debt that then the business is responsible for, and usually, most often, it's a combination of the two. So at a $15 million EBITDA company with a 25% EBITDA rate, it's probably fair to think that they could handle a 5x senior debt load. So that might be $75 million in debt that they're going to use as part of the purchase price, which leaves $105 million, which they would probably fund in equity. That comes out of their fund, just cash, right? There's way more to it. For those of you who've been in this space a while, I know this is oversimplifying. Let's not have a bunch of comments about it oversimplifying. But that's the idea. So they've got 105 million in, and now they own the company, and now they need to grow it. They want to sell it in 3 to 5 years, ideally, and they want at least 3 to 4x return on their invested capital, and so they want to sell it for somewhere in the 350 to 400 million range, so that they can pay off the debt and then harvest the results, the remainder. So let's say they need to achieve that outcome. Really, that means their goals are probably something in the order of driving revenue to 100 million at, let's call it a 20% CAGR, compound annual growth rate, and driving EBITDA to 25 million. That maintains the 25% EBITDA multiple, 20% CAGR. That gives us our rule of 40 again. But now they have 25 million in EBITDA. They've scaled it up, and they qualify for a higher multiple because the larger the EBITDA, typically the larger the multiple, as long as everything else stays roughly the same. And so let's say they were able to sell that for 18 to 20x, which wouldn't be unreasonable. Call that a $450 million sale price. Remember, they had $75 million in debt, so they have to take that off the top, and they're left with $375 million of results, that then goes back to the fund and eventually back to the investors. That's a 3.6-ish x what's called a MOIC, uh, multiple on invested capital. So 105 million of invested capital. What do we say? 375 million in returns. 3.6 MOIC is a top tier result for a private equity firm. So that's basically what they're trying to do.
Got ya. Yeah, lots of numbers there.
Yeah.
If you didn't follow along, rewind, listen to it back again, because
Yeah.
Interesting to hear the way that those deals work, even if it is oversimplified.
But yeah, I mean, it is oversimplified. There's all kinds of additional costs,
Yeah.
deal costs, and things that go into that, and adjust numbers and whatnot. But the main point is to think like an investor and know how they're know your own company's numbers, and therefore why how they're engaged and what their goals are and why their goals are what they are. Right? If you don't know those things, you're being told by the board, here's your budget and here's your results, and you might feel like, well, wait a minute, this is crazy. I don't understand how they came up with this.
Yeah.
It just feels like a spreadsheet exercise. Well, no, it's really what they're doing is engineering an outcome, and then working backwards to figure out how to achieve that outcome.
Yeah. So, where does marketing fit in this equation?
Yeah. Okay. So what did we say? There were a few things that were important. EBITDA growth was important. So from a marketing standpoint, I need to be able to grow EBITDA in a growing company, not in a shrinking company where you're just reducing cost. But in a growing company, you're trying to grow top line, but you're trying to grow top line efficiently. So marketing comes in and says, I can measure my channels. I can look at total cost of total customer acquisition cost.
Yep.
And then look at what are the channels that are most efficient, right? But it's not enough. I mean, we talked about this a bit the last time too, but it's not enough to just measure marketing's CAC, right? We have when we use the word CAC or the term, we have to make sure that we have cost of sales, cost of partner payments, any type of cost
Total
related,
go-to-market.
because that's the only fair way to evaluate the entire process to know what it's going to cost you to acquire customers. So they care about that. They care about scalability. They care very much about de-risking the investment. So when predictability is maybe even more valuable than rapid growth. Knowing, a private equity investor, they're not a venture investor. Venture investors want, a 10x return on one deal out of five, right?
Yeah.
And they expect the other ones to go to zero. PE doesn't do that. PE says, I need good, solid results out of every company that I invest in, and I'm only trying to, like, a 3x to 5x return is a home run in most cases. And so in those circumstances, that means that de-risking every investment, about getting a repeatable, predictable revenue generation model that you can then choose to scale up or scale back depending on what you're trying to achieve, is extremely valuable. And that's frankly, that's the CRO's job, it's the CMO's job, it's the CEO's job to be able to create that.
From a de-risking standpoint and how that information actually gets served to the PE company at the time, what are they looking for in particular around a model? Like, what's the data? What's the model? What are they actually being presented with in order to say, okay, that's an investment that I feel comfortable in, is risk-free enough for my capital?
Well, I think it's the same way you would look at risk. How much money are you asking me to spend, and what's the likelihood of conversion? If I have to spend $1,000 and I've got a 1% likelihood of conversion, and I've got to spend $1,000 per account, let's say, well, that sounds expensive. Compared to if I have to spend $100 per lead, and it's got a 40% probability of conversion, I'm far less risky in those cases. Those are probably, that's off the cuff, so those are probably really bad examples. But the idea is, what we want to do is we want to look at the entire revenue generation process,
Yeah.
starting at, you know, customer and the first touch point, and going to the end of their life with the company. So includes cross sell, upsell. It includes retention. It includes, do we expect this type of customer is going to negotiate discounts every time a renewal comes up, and how do we fight against that? And like all of those kinds of dynamics go into looking at the end-to-end process, and then taking it apart and looking at each step and deciding, how do I create predictability, and how do I reduce the risk that something unknown is going to upset that? And the lower the cost of each step, the lower the risk to me, right? Because I can fail if I can try something and it's going to cost me $10, but I can try it 100 times, and then I know, I spent $1,000 and I know whether it worked or not. That's great. If you tell me I need to make an investment in a third-party IT analyst organization that's super expensive, and I won't know whether that's successful until I go through an 18-month sales cycle.
Yeah.
That's super risky, right?
Yeah.
Like, I'm going to spend probably millions in between the analysts and the travel and the actual human beings that are in my enterprise sales force, and I don't know whether that's going to actually create the recurring revenue I need until I'm well down the road. So I want to, sometimes that's the right answer, rarely, sometimes, but I think that's the issue of risk that we're trying to address and battle.
Yeah, what's really interesting is, compared to our last conversation, which was all about CMOs in the boardroom and the information you should be presenting in that scenario, it sounds like actually the PE owners are looking for more detailed explanation of the entire kind of funnel and the repeatability, the predictability of that before they go ahead and invest ultimately. Whereas in the boardroom, like, you can forget most of that. Is that right?
They don't. Yeah, I know why you're saying that. In the boardroom, they don't want to be handed a slide deck from a CRO or a CMO that goes through every single stage and talks through every single finding. But they would love a pre-read, because what happens is in the boardroom, you've got a limited amount of time, you've got a lot of topics. There's information overload, and it's the partner that's sitting there. They might have one of their analysts with them, but if you give them a pre-read with all of the data, or the depth of data, or you're working with their consultants ahead of the board meeting and helping them look at the data, then you can, everybody can be up to speed, and you can have a strategic conversation in the room because everybody's already digested it. And analyze the data themselves, and they have an opinion on the topic, right? So I would say that's for the last time we talked, there was a CMO walking into their very first marketing meeting or board meeting, and yes, the counsel was definitely, don't go into loads and loads of detail, but even then, the conversation is still all about return on investment.
Yeah.
It's the vanity metrics that I think get CMOs into a lot of hot water.
Yeah, for sure. Where does LTV come into this? I don't think we've mentioned it yet. How important is that to?
Yeah, I mean, I think there's a lot of organizations that fail to recognize that, and Kara Brown has a book that she's recently put out. It's a great book, worth reading. But it talks about 3 funnels, and everybody understands the first 2 funnels, the lead funnel and the revenue funnel. But a lot of people forget about the customer funnel, and the customer funnel is your existing customers and the process they go through to increase what they spend with you, right? Whether it's cross-sell or it's upsell, your process there is equally important. And oftentimes marketing gets either left out of the loop, that whole thing gets handed to account managers and they stop talking to marketing, or people forget to spend money in marketing for their existing customers. And I think everything we do in the first two funnels are absolutely critical in the third funnel as well. So that's really what drives LTV, is being able to continuously serve the customer, make thrilled customers, but then upsell them, because when you're upselling them, you're creating more value for them, right?
Where does LTV though come into play for PE owners? Like, how much do they care about it?
Sorry. So I didn't answer your question, is what you're saying.
Well,
Lifetime value is a questionable metric, but it just depends on the business. In pure SaaS companies, it has a lot of value.
Yeah.
Particularly the easier in a business. Really, let me retract that. For LTV's value to be high, the ability to leave or switch has to be high. So if you have low switching costs, and with what you do, let's say you're selling Microsoft Office, and somebody could easily go to Google with very little actual effort, right? Some individual. Well, your switching costs are low, so wanting to know your LTV in a business like that is really valuable, because you want to know how long that customer is staying with you. In a business like I had at Trex, for example, we had customers for sometimes, like, we celebrated a 30-year history with one customer. Like, that's a long, long time.
Yeah.
And so calculating LTV there has very limited value, because like the risk of loss is pretty low.
Yeah. Okay. Interesting. I'd love to now kind of dig into your PE experience and understand a bit more about what the PE owners really want to see from the portfolio company's marketing when it comes to results, the kind of engine, the approach that they take. Is there anything in particular they're looking for that our listeners should think about and be aware of?
Yeah. I mean, I think the more you can structure your reporting to the board, and really the way you talk about it even internally with your CRO and your CMO, is let's look by channel, the entire process of lead capture, attraction, awareness, attraction. Everybody has different terms, but top of funnel through all the funnels to end of life, and let's look at what meaningfully drives revenue, and what are the costs associated with doing that, and what are the timelines associated with doing that. And as you take your business apart, and you can identify, if you have the right data is critical, and we can talk about where that data comes from. But let's say you have a HubSpot implementation front to back, and you've done it the way we would teach you to do it, then you're probably in a good position to be able to analyze, here's every single channel that I have for generating revenue, and here's what my costs are at each stage, and here's the percentage of deals that come through, and and here's how long they take, right? Because time matters, and so I can do the math there. It's all math, right? I can do the math, and I can determine, okay, this is the most efficient. The only thing that's not math is, can it be scaled, right? So this might be great. This channel might be my favorite channel, but is it repeatable? Yeah. And so if I can, turn up or down, because the value of repeatability is important, because the PE investor at certain times in their hold period are going to turn the dial way up, grow as fast as you can. Yeah. Right. But as they get ready to exit, they're going to turn that dial back. And it's not as fun for a marketing leader who's like, high growth, let's go. Yeah. But there is an appropriate time where it's time to, show that the business can still grow, but not grow quite as fast, because we need to establish that it can also generate real significant earnings. Yeah.
So just to simplify that, basically the PE owners want to know, if I give you 50% more budget, do you have places where you can deploy that where I'll get a good measurable return on that?
Yeah, that's right. I mean, if let's say marketing comes out of operating costs, right? So 50% more budget let's say you had 5 million and you get 2.5 million more. Well, that's 2.5 million of operating costs. I'm sorry that I keep going into math, but math is
Yeah,
it's
that
all
is
the,
it. Yeah.
if you don't understand the numbers, then you're definitely not going to serve the PE firm well.
Yeah.
So 2.5 million of operating costs. If you're looking for a 25% EBIT, let's say you're looking for a 20% EBIT because the math's better, then I need to deliver 20% earnings,
Yeah.
and now I have to do gross margin. So I need to know how much of my revenue comes in, drops to below cost of goods sold, and so I'm going to lose the audience if I keep going through this math.
Stay with us, guys. Stay with us.
Here's the thing. Here's what I'm trying to say. If a PE firm is going to give you more money, you need to do the math to see what type of return is necessary. When I say are they going to give you more money, they're not actually giving you money. They're just giving you more budget.
Yeah.
They're giving up earnings, right? Every dollar spent in marketing is a dollar that would have dropped to the bottom line, and maybe that's the most important thing. And so if you're going to do that, you've got to be able to prove that to yourself and to the firm that you're going to deliver a return in an acceptable timeline that will ultimately add to their EBITDA percentage. It will increase the percentage of revenue that's dropping to the quote unquote bottom line.
Have you seen our split funnel analysis? Yeah.
I love your split funnel analysis.
Cool.
Yeah, it's one of my favorite things.
Nice. Has that got a place here? And you can split that out by any way you want. It doesn't have to be, particular marketing like media spend channels. It could be pipeline sources. It could be, like high intent leads via the website, partners, outbound.
Yep.
If you split those out by total investment, total return on pipeline, total return on revenue, is that the kind of thing?
That's exactly
pulling
right.
in here. Okay, interesting.
Yes.
Right. Okay. I've got my marketing brain is aligning with this now. I like it. Okay, good.
So I mean that's really as complicated as it gets. I think the challenge is that there's so much data that you have to pull in to be able to do this thoroughly. But that's where a partnership with your CFO, a really good Marcom stack or sales stack, between those two things, I think you can usually pull the data together that you need.
This podcast is brought to you by Blend. We're a B2B website and demand generation agency. We work with ambitious businesses just like yours to create and execute effective demand generation strategies that drive pipeline for your business. We also recognize that your website is the most important asset you have in marketing. So we specialize in building scalable websites on HubSpot that convert the demand that you've created. If you want to find out more about our services and see real results that we've generated for businesses, visit blendb2b.com. Obviously, there's a lot of math that's come up here. There's a lot of numbers, there's a lot of KPIs to be hit, a lot of numerical data that the investor base is looking for.
Yeah.
I might be wrong here, but are there any other things outside of numbers that they actually care about?
Yeah, absolutely. I think the numbers are critical, but you can help your investors in other ways too. Marketing in particular should be able to educate the investor base, the team, the PE team that they're working with, on the market that they're in, on market dynamics, what trends, what's changing, on competitors, on what's happening with those competitors. If there's M&A in the space, I mean the PE firm will probably know that too, but you can give them more of a market view, customer view of that. And so I think, if you have a seat at the table, coming not just with, my Bean County head, but also a real solid appreciation of your market dynamics and being able to educate somebody who, isn't in your market every day and help them understand what's happening in that space is super important.
Yeah, I love that. I love that they even value, that kind of thing.
They do.
That's good.
Yeah, for sure.
Okay, so now that we kind of understand what PE companies are looking for from their marketing teams, it'd be interesting to see how we can unpick what that actually looks like in terms of actionable strategies? Like, can we give our listeners a solid playbook or at least an idea to work from that will please their PE company and investors?
Yeah, I mean, this is a little self-serving now, but that's what Blend did for me 10 years ago. Was help me build that, and I know we've done that for a lot of our other clients too. I mean, being able to create a data environment that allows a customer to measure all of these things that we're talking about is kind of, ABC of the foundation of what we do. I'm sure you see that too.
Yeah, absolutely. And yeah, this is, what we do without being totally self-serving. But the approach here, from my mind, that would serve the PE investors as well is the general approach of working back from revenue, identifying the conversion points along the journey and optimizing every single stage to get the best return on investment. So that means initially looking at the conversion between pipeline and revenue. Now, some of that is out of marketing's hands. It just is, quite simply, not trying to create a battle here between marketing and sales, but sales have a job to do to convert the deal and get it over
And
the line.
it's not only sales either, right? It might be channel sales. It might be
Exactly.
you may be
Yep.
selling in all kinds of different ways. And so this absolutely isn't about sales and marketing, but marketing is the place where the data should come to be, to have one view of the truth. And it's important that the marketing leader aligns with the sales leadership, whether it's a direct sales force leader, whether it's partner sales people that are sales teams that are in other companies altogether. The CRO is going to need to manage those relationships, but understanding the costs,
Yeah.
we can pull all that back into the stack and be able to then report on it.
Yeah. And marketers don't like saying this, but I'm happy saying it, and I'm keen to get your thoughts on it. A lot of marketers don't like saying that marketing's job is to help sales sell. From my perspective, that's totally true.
That's the only reason marketing exists, in my opinion.
Yeah.
That may get me in trouble, but I mean, yes, they create brand, right? There's
What
no
does it
point
lead
in a
down to?
brand
Yeah.
unless you're finding a way to turn that into
Yeah.
revenue, right? Now, if you're in a business where marketing can turn it into revenue without sales, even better for an investor, right? Like if you're in let's call it an e-commerce environment where you can find a way to eliminate the need for individual salespeople. My sales friends are probably staring daggers at me right now.
No, they've turned it off a long
Yeah.
time ago.
That's funny, but that's true. But no, I mean it's true though, right? Is lowest cost of customer acquisition that is both reliable, low risk, and scalable. And so I think marketing's the right place for all that.
Yeah. So, working your way back through that playbook of starting with revenue, understanding how pipeline converts into revenue, what's marketing's role there, how can you influence that, work with sales closely to give them the resources that they need in order to close those deals best, then take another step back. I'm just doing this off the top of my head now, but it's all around the high intent website conversion to pipeline, ultimately. So the people that you're actually getting through the door, hand raisers saying, I want to buy from you, I want to talk to sales, how are you getting those into the pipeline as quick as possible? Identify any gaps in that process that's slowing things down, things you can do to accelerate those deals as fast as possible. I assume PE companies are going to be all over that.
Absolutely, yeah, absolutely. And I mean, we both know that there's all kinds of tactics and strategies once you get to that point. For some companies, it's going to be an ABM strategy. For some, it's going to be an e-commerce strategy. For some, it's going to be something different. But the point isn't to predefine in the playbook. The point isn't to predefine the right answer. The playbook should be about decomposing the business and understanding all of the transition states and why they happen and how long they take and how much they cost, and then be able to engineer intentional growth. And that's why we call it growth engineering.
Yeah. The playbook starts with your business one and what you offer and how the market needs that ultimately,
Yeah,
and
that's right.
having the deepest possible understanding of your audience and your buyer will give you a competitive advantage over everyone else, because you
100%.
understand what they like, what their challenges are, their deepest, darkest secrets and challenges that they don't want anyone else to know. You understand how they buy, you understand how they consume information, you understand how they research, how they evaluate what truly matters to them. And if you compare that with what you offer, you're going to be okay.
Yeah. So I mean, I think that that playbook is made up of really three things, and it's built. You're right. It's built. We have a foundation, but it's built for each customer individually because it has to take apart that customer's business and really understand those things. But the other two things beyond the that data and the math is the stack, and the stack is repeatable, right?
Yeah.
I mean, we're HubSpot fans. We love the platform. There are other
Yeah.
platforms. People can use other platforms. Um, they're not as good as HubSpot, but the the point is understanding what stack works, and there too you have a cost benefit analysis in each step. But having a stack that is fully integrated, fully connected, allowing you to gather the data you need quickly, automating as much as you can for the salespeople, right?
Yeah.
So that you're making their lives easier, because we know salespeople, generally love to live in CRM. And so, yeah. And then, I'm sorry. And then the third section is team structure, deciding on the human investments you're going to make. And again, that is going to depend on the business and the approach there. But I think channel and sort of engineering your growth strategy, having a stack that works, and then having a team that supports that engineered approach is how you build growth.
Yeah. And ultimately, when it comes to improving the things that the PE investors want to see, and which channels to go after first, ultimately is firstly identifying the best performing ones for you, and like you said earlier on, are they scalable?
Right.
Prove if they're scalable, invest more, dial it up, dial it down as and where you need to, prove out the thesis with the audience understanding, the buyer knowledge. Are your buyers operating there? Like, if so, yeah, it's probably a good place to invest. You can test that out though, for sure. There's a really interesting approach to testing out new channels, which I'm not sure if you've heard before, and it was from Chris Walker a few years ago now. I'm not sure where he's gone. I do miss him dearly. But it was called Revenue R&D, I think he framed it as, and they had a positioning shift on this. And it was a really interesting framework where it was all about setting aside channels and investment based on core thesis of like audience understanding, but without diving too deep into a particular channel. So you'd have your thesis that you work with. Okay, our audience is on TikTok, for example. They are consuming XYZ content on there. Perhaps that's a place we should play, without going ahead and investing wildly in terms of TikTok ads or personnel to come in and help you, bolster that resource to create more content. How do we start just internally with what we have right now and scale up to get X results? So that might be, okay, we want to see, this amount of pipeline from TikTok over this period of time. If it doesn't work, like, let's can it, basically. And it's a proven way to invest small amounts of budget, but to test, to scale, and to iterate. And it's like taking one thing at a time, not spreading yourself too thin to test everything and getting super excited. It's like a methodical way to work through channel by channel and see what's truly working. And things that do work, okay, we've hit our target for pipeline, whatever it may be, stage 3, stage 4 pipeline. Might be too early to see revenue, depending on your sales cycle. But okay, based on that, we can invest a little bit more. Then if we start seeing revenue from it, okay, let's invest more and more and more until you start to see, diminishing returns.
Yeah, I generally agree with that approach, right? Fail fast, try small, fail fast, do a lot of experiments. That's usually good advice in whether you're doing product-led growth or whether you're doing any, like, it's just usually good advice. The only thing in this case that I would say that I'd be a little cautious of is that there are going to be channels that have minimum investments to really test it, right, and be able to determine. And so you are at risk if you don't do enough. You are also at risk of saying no to a channel that could have been really productive for you. I'll give you an example that I see all the time, and it's channel partners.
Yeah.
I see so many companies say, "Well, we're gonna go build a sales channel, and we're gonna go sign up channel partners," but they don't. But if you're running a channel program, you've got to make. I'm now selling through another company's sales team. Well, that means I need to spend time educating that sales team, supporting that sales team, giving them the resources to be able to execute effectively, like they were my own sales team, right? And very few people will commit that. They'll go out and they'll find partners and they'll sign partnership agreements and guarantee referral pricing and so on, and and they don't follow it all the way through to say, you know what, I'm going to have to invest $250,000 in this partner annually to be able to deliver hopefully 5 million in revenue, right? But if I'm only willing to invest 10 grand and then I'm like, hey, where's my sale? Just oftentimes I see people going down that road. So I would say that let's just make sure that with each investment, we're evaluating the minimum viable, not product, minimum viable investment.
Yeah. And channels are a really good example, actually, because, you know, you mentioned it from the sales side there, which is really interesting because I've seen it from the marketing side as well, right?
Sure.
Like with channel partners, are you giving them the marketing resource and help that they need in order to market your product, your service to the best of their ability? In most cases, no.
Right.
You know, like you're 5 steps ahead of what they have in terms of what you're marketing, and they need the support in order to be an effective channel for you to market through and to sell through. Yeah, you need to train their sales team on how to sell like you and sell your products effectively, but you also need that support from marketing.
Yep, absolutely.
Okay, cool. Let's kind of start to wrap things up here.
Sure.
Maybe with some like common pitfalls, mistakes that you've seen in the past from that portfolio company marketing.
Yeah, I'll hit them quick because I think we have covered
fire.
most of them. But you know, lack of commercial understanding, lack of understanding where the investor is coming from. Hopefully, we killed that ad nauseum earlier in this conversation. But it's important for a marketing team to understand what their investors think about. Focusing on soft metrics is certainly one that we've talked about. You know, the last time I was here and this time too, that these vanity metrics that, you know, don't tie directly to revenue.
Yeah.
Get them out. You don't need those. Siloed operations, where you can't, because you've chosen to set up your stacks in a way, your tech stacks, your data collection in a way that won't allow you to connect the cost of sales and marketing and channels and customer success and anything that has to do with customer retention. If you can't pull that all together and then slice and dice it because of your silos or because of the fiefdoms in your silos, the politics of your silos, which is equally challenging from if you don't have a top-down direction. I think that those are common challenges, and then maybe the last one I'd cite is PE investors and board members are a lot like anybody else. They're human beings. They are at risk of shiny object syndrome, and so something works, and they're going to grab onto it and like any of us would, like it's a silver bullet. And most of us know there are no silver bullets in business. That you know, the business is constantly changing, and we need to be able to keep measuring and identifying when there's signs that this thing that did work isn't working quite so much anymore, and we need to get ahead of it and know what our other options and levers are. And so helping your PE firm recognize when that's happening and when they're maybe getting little too enthralled with one particular thing, and we need to really look at what the other options are. I think is important.
Yeah, are you talking about, so they might be bringing in something from another company that they've seen work, or are they looking at your data and potentially wanting to invest more in something that is going to fail?
Both. I think the best case is the latter, that
Yeah.
they're looking at your data. The worst case is when they bring something in that worked somewhere else,
Yeah.
and they think it's just a magic bullet or silver bullet that is going to carry through every customer or every portfolio company. Yeah, I mean that does happen, but hopefully and I shouldn't say that that's always a bad thing. There are like being in a portfolio is great in that you can learn from if the PE firm's smart, they'll give you opportunities to get access to other portfolio leaders. And so you can trade, I use this stack, I use this stack, I use these processes, and so on, and learn from each other and see what's working and what's not. So yeah, that's wonderful. But if it's just this thing worked over here, so everybody else is going to use it, that's less amusing.
Yeah, it doesn't work most of the time when it's based off of that ethos in terms of it worked for them, so it should work for you. Sometimes that's true, but it's best to prove that with the commercial results yourself.
That's right.
Yeah, cool. All right, we're kind of coming up to an hour now, so I'm sure you've got some wise words of wisdom and thoughts to leave us with.
Okay, I'll give it a shot. So I think the first thing, evaluating marketing based on value creation and understanding the investment thesis that went into that investor buying your company is job one. If you don't understand that, go talk to your CEO, explain to him why he needs to give you access to that understanding and how it'll help you do your job better, and then pound on the table until they do. Second, if you ask yourself, what would you want to see if you owned a company, but you weren't in it all the time, and let's say you had 8 board meetings a month that you were going to, and you were trying to evaluate in a very short amount of time whether that investment was working out or not, and whether there were any course corrections or anything that needed to be done. Walk a mile in their shoes, right? Mm-hmm. Give them pre-reads. Treat them the way you'd want to be treated, and I think that can be very helpful. And I'd say maybe most importantly, tomorrow or today, depending on what time you're watching this, go to your marketing dashboard. Can you clearly link every metric to a financial outcome and evaluate each key stage of your buying process or your customer's buying process, and look at what the different channels are and be able to evaluate time and cost and scalability. And if you can't, build a plan to go do so. And if you need Blend to help, we're right here. But seriously, that should be everybody listens to this. If you don't have that, you owe it to yourself and to your owners to go build it.
Yeah, go get it. The amount of times that we hear marketing leaders say, I don't have access to this data, to that data to try and prove these things. We say, well, you have to get that.
Right.
If you want to prove marketing's effectiveness in the way that PE owners care about, in the way that you should care about, it's essential.
I mean, if you don't want to be replaced.
Yep.
Because the one thing that I know about investors is that if something's not working, they will fix the problem. And if you can't do the job, this is part of the job of being in a PE-owned portfolio company, is to run it the way they need it run. Mm. And so, yeah, I think that's absolutely necessary.
Yeah, cool. All right, well, let's wrap it up there. And
all right.
Yeah, I'd say again, Josh, the insights we have from you on here, I think are just so brilliant for our audience.
Go on.
It's not the classic marketing advice that you get, and that's why I think I love it, because there's so much of that out there available. And of course, we can bring a lot of that to the podcast, but understanding, and even from my own benefit, like I love doing podcasts because I get to sit opposite people who are usually smarter than me, and I like on particular topics. And
Except for today.
well, I would even say today. And yeah, it's fascinating to learn from and like elevate your understanding of not only marketing but also business context. Because if you can apply your day-to-day marketing job to the context of what your PE investors and owners are thinking about, then like you'll do a much better job for yourself, your career, and your company.
Absolutely right. Absolutely right.
Cool. All right. Yeah. Let's wrap it up. Absolute blast, Josh. And yeah, we will catch you all next time. Bye, everyone.